And good morning and welcome to today's Monday morning mortgage message. This is the update for March 21st, 2022. And boy, is it a doozy to start the Monday. So I want to call this March Madness. Today's a Manic Monday. I'm going to jump right in to kind of show you what the markets are doing real quick. And it's been a wild ride already today. So let's have a look at where we're at. That's 80 basis points. We are down for the day. Yikes. That's a big move. It's not a fun move for buyers. They're going to be really upset, frustrated. They're going to be scratching their head saying, why and when are rates going to stop this out of control spike? So let's look over that to kind of see why we had such a big run today. Let's look at the actual charts just to give you an idea of where we're at. And just have a look-see here. So the 10-year is up 15 basis points. That's a big jump in that 10-year, and we'll kind of look at that as well. But as we see this candlestick, we're way below this Fibonacci level. We were up here on Friday. We broke beneath 2 Fibonacci levels. So look at this just cliff that we're jumping off of right here. The reason we're having this big cliff jump right now is the fears on the balance sheet runoff. So we had spoken about how the Fed funds rate really doesn't impact the mortgage rates themselves. In fact, if you look back on here when the Feds announced their rate hike of a quarter, for the day, there was a lot of volatility up and down, but then the next day it came back, and then the next day after that it came back, and we were actually better on mortgage rates a couple days after the Fed funds raised their rates. Now, remember, the Fed funds rate is the rate at which banks borrow money from the Fed window and from each other on a 24-hour basis. It's very short-term money. Inflation doesn't affect it. It's really created to, raising the interest rates on that has created to slow down the monies pushed into the market to pull down on inflation and really pull that back. But that other lever that the Feds work with is their balance sheet. And when they mention that they're going to be running off their balance sheet more quickly and more aggressively, that's where we're at today. Basically, what that means is they're going to be selling all of the mortgage bonds that they've been buying to the tune of $60 billion at a time. They have a $7 to $8 trillion balance sheet. Don't quote me on that because it may be a little bit more than that, of mortgage-backed securities and mortgage bonds that they've been buying for the last 10 years or so. That quantitative easing is what that was for. That's to artificially bring the rates down. They're now saying they're going to sell that off. That's going to flood the market with bonds, making them less valuable, making the rates go up. That's what's happening today. So that's why we're seeing it's only 75 basis points right now, but that's a lot. Basically what that means, a rate on Friday that didn't cost any points and now cost 0.75 discount points to get that same rate. So a big move. Let's look at the 10-year real fast, and then we'll jump into kind of where rates are at for the consumer. So look at that big candlestick upward on the 10-year. That is a huge jump. That's a big one, guys. So it's a big day. Rates are higher. I actually locked in this morning. A couple of our customers that went under contract over the weekend, we locked in when it was about 25 basis points lower. I'm sorry, for the day. So we saved them about 55 or 50 basis points already because we are seeing another rate change for the worse, the second today already. So it's a bad day. So let's kind of look to see where mortgage rates are shaking out. We have the average right now, 4.5 with 0.4 points. This is a national average within Mortgage News Daily. Gives you a good barometer of what's happening with the market. And it is a really good place to go just to see kind of what's happening in the markets. If you look kind of see what's happening with the spike, look at that spike right there. It's hard. It's hard to watch, and it's not good news. We just have to roll with it and know how to explain it to our customers. Highest rates in 3 years is what all of the headlines are showing. Here's a really interesting chart. This shows kind of the Fed in blue with what mortgage rates have done. So if you look back here, and this is back in 2015, quarter one, they raised the Fed funds rate. Rates spiked a little bit. Then they came back down. They raised the Fed's rate here, and rates came down. Remember, when they raise the Fed funds rate, it's slow, which makes rates better. And look, boom, 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 boom. we saw the mortgage rates drop, and they kept raising them and mortgage rates kept dropping. So there's not a direct correlation with mortgage rates and the Fed funds rate. That's an interesting chart to show that. But yeah, guys, it's tough. We're down 73 basis points for the day. With your customers, if they're going under contract, I highly recommend they lock right away to secure these low rates. Again, 4.5 is the average on a 30-year fixed according to Mortgage News Daily. That's with points. So without points, you're probably closer to 4.625, 4.75. 15-year is hovering just under 4, and that's with points. 30-year on the FHA, right around the 4.13. And again, this is the national average. Jumbo is right around the 4%. And then you have your adjustable mortgages, which are very similar. So it's tough out there, guys. Keep your boxing gloves on. It's a fight to get these buyers under contract. Don't forget about our fully approved pre-approvals. They really are helping our contracts get accepted. When you can close in 2 weeks, there's no conditions on a loan, and we can move forward. So if you have any questions, reach out to me. You can always reach me directly on my cell, and woolenmortgageteam.com is our website. Have a great week, guys, and we will be in touch.